and welcome to the Business Standard Morning Show. I'm Kanishka Gupta. Let's have a look at the stories for the day. Kishore Biyani took decades to build his empire, brick by brick with a lot of patience. Starting from a humble family-owned textile shop, he went on to lay the foundation of a massive empire of retail stores like Pantaloons, Big Bazaar, Easy Day and FBB. But the ground beneath his feet is slipping fast now. 3 of his future group companies are going through corporate insolvency resolution process. So what led to his downfall? Tushar Verma and Bhaskar Kumar bring you the answer.
After taking off in the early 1990s, the Future Group hit its peak in 2019. It clocked a revenue of more than rupees 30,000 crore from its network of 1,700 stores that year. Fast forward to now, and the group is under a burden of a massive 32,840 crore rupees debt. The downfall was rather quick. One of the group companies that is under insolvency process, Future Retail Limited, registered a loss of rupees 3,180 crores as of March 2021. In the year 2020, the group had registered a profit of rupees 33 crore, and its peak profit was in 2019 at rupees 732 crores. So, why have things come to such a pass?
What he did was he expanded too fast. He used mostly borrowed funds to expand, which is a problem in retailing because where the margins are small and your cost of borrowing is high, it doesn't leave you too much degrees of freedom in terms of success. Not only that, like in the license Raj, he tried to stop the international competition from coming in, which is a problem. Why? Because when you stop international competition from coming in, you're not developing your own capabilities in your organization to compete with the best. Then he went into many unrelated businesses, at least the insurance business kind of thing, where he had no competencies at all. He did not hire the best talent to build the deep retail competencies required. And the problem was he didn't need to go into these unrelated businesses because retail was a big enough opportunity in India. Of all industries that I know, retailing is the most cutthroat competitive business. In retailing, we talk about the wheel of retailing, which is that retailers succeed, but over time they fail because they let their costs go up too much.
I think the key reasons for Future's downfall is really the rampant and unrelated expansion. One level insurance, cinema, and the other is rather rapid expansion. So I'm not sure they really checked the potential of an area. The other, I think they quickly went into too many retail formats. That is one thing that certainly was not well thought through. And of course, I think the big tickets was the onslaught of e-commerce. The last 1 decade, the rapid growth of Flipkart, of Amazon, and then of course the competition that came, from new entrants, Reliance, of course, Star Bazaar from the Tatas, Spencer's, and of course some of the larger global retail formats that also gained entry into the country. So in effect, Future was not able to, hold on against all this and accumulated, unsurmountable debt that really grew too large for them to service.
3 of the 19 companies under the Future Group are undergoing insolvency proceedings under the Insolvency and Bankruptcy Code. These are Future Supply Chain Solutions, Future Retail, and Future Enterprise. The bankruptcy case against the company has been filed by multiple creditors across the country. To come out of the debt, the group had struck a deal with the Indian behemoth Reliance Industries worth almost rupees 25,000 crores in 2020. The deal, however, was called off last year by the Ambani Group. A prime reason that prevented the deal from being materialized was the tussle Future Group was engaged in with the e-commerce giant Amazon. Amazon, through its earlier investment, had 3.58% indirect stake in Future Retail Limited. When the deal was signed between Reliance and Future Group, the e-commerce giant objected, citing a shareholder disagreement. Reliance, however, found itself in a sweet spot even though the deal did not go through. It took over 830 stores of the Future Group, which operated Big Bazaar, FBB, and Easy Day. This takeover was a result of non-payment of dues by the Future Group. Where does the Future Group stand today? Is there any hope of its return?
To use of cliche, they really have no future. They're left staring at an abyss. Having said which, I think Mr. Biyani has truly been a pioneer in the retail trade in India. So the deep knowledge and insights that he has are truly invaluable. And therefore, if they make a fresh beginning, it'll have to be from scratch, really getting down to the basics. And I think they would have the potential to do that.
So what stands in the future is that I think, offline retail growth rates that way have converged. But I think the only potential therein is online. So if they're able to kind of innovate online, have some app, have a better user experience, I think they can basically, try and, do things differently. But we don't see that, as a probability for now. I think the Future Group may continue to be a laggard as compared to other conglomerates like Tata and Reliance, which have scaled up the omni-channel route, online and offline both put together.
Experts believe that Biyani's Future Group might have been one of the leading retail brands in the world had it not diversified into unrelated industries. Along with aggressive expansion, the group could not withstand the competition from growing e-commerce in India. With 3 major companies under the insolvency process, the future remains uncertain.
Biyani, who is 61 now, will certainly try to script a comeback. Meanwhile, the Indian rupee is also trying to make a comeback after depreciating by around 10% last year. And it is also going places now. It is taking baby steps towards becoming an international currency like the dollar. So, is the Indian rupee headed for internationalization? Let's find out.
It's time to put the rupee above US dollar. To that end, India is now prioritizing international trade in Indian rupee with its neighbors. In December 2022, the Union Minister of Commerce and Industry Piyush Goyal and his Bangladeshi counterpart Tipu Munshi discussed the settlement of trade in Indian rupees in New Delhi. And now, Sri Lanka is exploring the possibility of using the Indian rupee for economic transaction with its immediate neighbor. Meanwhile, 3 Sri Lankan banks had already opened Vostro accounts with Indian banks in January 2023. Banks from Mauritius, Malaysia, and other countries have followed suit. India and Bangladesh have also agreed on bypassing the dollar and trade in rupee and taka after a recent meeting of RBI Governor Shaktikanta Das with his Bangladesh counterpart Abdur Rauf Talukdar in Bengaluru. Russian banks were the first to approach Indian banks to open Vostro accounts, but no transactions in rupee have been reported from Russia so far. Last year, the Reserve Bank of India initiated its International Settlement of Trade in Indian Rupee mechanism, following which 8 nations have opened 49 special rupee Vostro accounts with Indian banks to facilitate overseas trade in Indian rupee. Several other nations have also shown interest. The mechanism for international trade settlements in rupees at market-determined exchange rates means that Indian importers can now make payments in rupee, which will be credited to a Vostro account of the corresponding bank in the partner country, while Indian exporters will be paid from the balances in the designated Vostro accounts. The surplus rupee balance in the Vostro accounts can be used for investments in government securities, payments for projects, and for trade advanced flow management. India is reportedly looking to bring countries that are short of dollars into this mechanism.
RBI has proposed to make a rupee Vostro account through which the trade settlement will happen among importers and exporters, and our government is proposing this to the countries where they have very low reserves on the dollar side. As you know that there are many countries like Sri Lanka, Nepal, Bangladesh and many African countries also. They are going through the tough phase.
But the internationalization of the rupee does not come without its challenges. There are risks related to exchange rate mechanisms and repatriation of money.
So I don't think as a nation we are still not ready, and we need to be ready to to take that plunge at some stage. But we need to do, and I think over last 15 years, lot of liberalization happened. Lot many transactions have been converted into auto mode, but still we have a large number of transactions to be taken to that. For example, I can't borrow easily. There are so many regulatory controls. I cannot have equity flows coming to me. Foreigners are not permitted to do many transactions in India into many entities. So I think there's so many restrictions on that. So for trade also there are limitations on that. So I think which is not there in currency, which are global currencies. Like in dollars, you don't have those restrictions. In euro, you don't have. In pound, you do not have. So I think, or yen, you do not have. So I think those currencies which have become global, I mean, there's a level of prosperity of a nation, in terms of per capita, when you can really reach that level. We are still nowhere there.
The idea of rupee going global is critical for India. Saving foreign exchange and improving the value and stability of the Indian rupee are only some of the long-term perks of this move. But for the Indian rupee to go global extensively, the country needs to step up its export and ease trade-related restrictions.
Moving on to markets, this week is set to keep the Wall Street investors busy with retail inflation data in India and the US. This comes in the run-up to the US Fed policy outcome. So how will these key events dictate market trajectory going ahead? Here is Harshita Singh and Rex Cano's report.
Indian equities witnessed extreme volatility last week, swinging between sharp losses and gains as US Fed Chair Jerome Powell reignited fears of higher interest rates. After noting the beginning of the disinflationary process last month, Powell switched gears in his recent testimony and said that rates could go higher than previously anticipated. All eyes are now on the US Fed rate decision on March 22, which will set the tone for the market trajectory. Meanwhile, market experts foresee domestic equities to remain volatile in the near term.
In this upcoming FOMC meet in the month of March, we expect Fed to increase interest rate by 50 bips. Not only that, we believe Fed will not stop here and will eventually increase rates by another 25 to 50 bips in the ensuing FOMC meets. The current interest rate, which is around 4.5 to 4.75% range, will eventually settle around 5.5 to 5.75% range over the next 2 to 3 months. The reason for this stance is basically very high stubborn level of inflation. Last month, US CPI inflation reported a number of 6.4%, which was much higher than the estimate number of 6.2. Not only that, various macroeconomic indicators, whether it is labor market, trade data, consumer spending, manufacturing, have not shown any significant decline. So overall, we expect markets to remain volatile in the coming 2 to 4 months. We have instances where Fed will decide on their interest rate trajectory given how the inflation data will pan out. RBI most likely will increase rates to support currency as well as fight stubborn inflation over growth. And on the other side, we have also seen some moderation in growth, which will remain under pressure as long as the interest rate remain high. We believe all this will put pressure on the markets, and markets are expected to remain sidelines for the next 2 to 4 months.
This week, the February CPI inflation print in India and the US also remains crucial. According to a poll by Reuters, the February retail inflation is expected to slightly ease to 6.35% from 6.52% in January. This will still be above the RBI's upper threshold of 6% for a second straight month. Against this, technical charts suggest range-bound trade for the benchmark indices.
The Nifty 50 is yet again seen testing support at its 200 DMA at 17,400 odd levels. Moreover, the 17,350 level is a key level to watch out for as it coincides with the 50-week moving average and a 20-month moving average. As long as the index holds about 17,350, a quick revival in sentiment cannot be ruled out. However, in case 17,350 is broken on a sustained basis, the index could slide another 1,000 points to 16,300 levels. In the interim, the index may seek support around 17,030 odd level. The bias for Bank Nifty is likely to remain negative below 40,900. The banking index could test 39,500 on the downside. This week, the Sensex may swing in the range of 58,100 to 60,100, with support likely around 58,750 and 58,300.
That said, equity markets will track their global peers today following last Friday's jobs data released in the US.
Just a few minutes drive away from the busy Dalal Street, one can spot hundreds of colorful fishing boats dotting Mumbai's shoreline. And had it not been for the litter, it would have been perfect for your Instagram feed. Also, not just our coastlines but our deep seas too are increasingly getting polluted. Rampant shipping and litter are wreaking havoc. But a new treaty offers some hope. We explain this high seas treaty for you.
Early this month, close to 200 nations agreed to a United Nations facilitated high seas treaty to protect marine life in international waters. UN Chief Antonio Guterres called it a victory for multilateralism and also for global efforts to counter the destructive trend facing ocean health now and for generations to come. The treaty fulfills the long-pending need for a legally binding mechanism to conserve the valuable marine resources that are under threat from indiscriminate anthropogenic activity, pollution, and climate change. Once implemented, this pact will set aside about 30% of the oceans outside the exclusive economic zones of the countries as protected areas by 2030 to allow them to recuperate. These marine zones would be like wildlife sanctuaries where any activity harmful to flora and fauna is prohibited. At present, international waters, which are outside national jurisdictions, constitute about 2/3 of the world's oceans, and they are open for unrestricted fishing, navigation, mining, research, or any other activity by anyone. About 10% of all the marine species are at risk of extinction, and over 40% of the threatened species are particularly vulnerable to global warming. Overfishing, increased shipping traffic, elevated salinity, pollution, and climate change, including oceanic heat waves, are hurting marine biodiversity. Whales, sharks, several types of shellfish, and a horde of other fish species are under pressure because of their growing demand for food and making drugs and various other pharmaceutical products. Evidently, only large companies of developed countries have the capacity to exploit these deep sea regions. Most of the developing countries are unable to optimally tap the resources of their EEZs. The marine sanctuaries established under the new treaty would put limits on fishing activities, delineate shipping routes, and impose well-judged curbs on exploration works like mining, particularly when these are undertaken in the seabed deeper than 200 meters below the surface. The objective, obviously, is to avoid damage to fish breeding grounds and minimize the scope for pollution, including noise pollution, which can impair aquatic life. However, environmentalists, mindful of defaults in meeting the funding pledges for climate mitigation action, are skeptical about the developed countries' assurances for providing financial, scientific, and technical support for maintaining the ecological health of the oceans.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.
This high seas agreement is still at the draft stage. It has to be ratified by all the participating countries to become legally binding. That is all for today. For more news, views and analysis, please log on to business-standard.com. If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.